So I was just wrapping up my work and I was about to go down and take care of my newborn son, but I thought, hey, I might as well just record this video first and share my success with you. So we're just wrapping up Q1 2022, and this is one of my portfolio results. Here you can see this is my non-retirement accounts. For people who are in Canada and US, this is my regular investing account, not TFSA, not RA, not RRSP. This is a regular investing account. And since January 1st, 2022 to today, which is actually beginning of April, the increase is around 22.9%. So that is actually not bad. I'm pretty happy with the result because I'm able to turn this portfolio around. So if you have been following my channel for a while, then you'll realize that last year was quite volatile. I'm sure a lot of you who have invested in technology have been down. For example, PayPal is down, and I talked about how to hedge and reduce your risk there. And I also talked about like how to think about the Chinese stocks as well, which is very high risk. So when you're looking at this portfolio, there are a couple of things I did to turn it around. And that's what I want to share with you in this video today. So one of the significant changes I made is that I invested in oil and gas. In 2021, near September, we were looking at oil and gas stock before winter. So at that point, within Investing Accelerator, we worked out what is the supply and demand of oil and gas. Why is Europe has such oil and gas crisis? How does China come into play? What is the inventory in Russia and the rest of OPEC? And we followed that quite closely. So then in the end, I invested in an oil and gas company called Suncor in Canada, and oil price shot past 100 to 120 and something. And then at that point, I made over 100% from oil and gas, and I exited. So that is one of the positions in my portfolio. And if you look at my performance here, and I compare that with S&P 500, then here you can see that even though I'm at 20-something, 24%, depending on the day, for my portfolio, it fluctuates a lot because this is certainly a very rocky year, and you can see it goes up and down a lot. So as of the quarter end, S&P 500 is at negative 4.95%. So if you are investing in index funds, then this quarter unfortunately is negative, but then if you look long term, it should be positive. If you look at my portfolio, then at this point I'm at 20.35% return from January 1st to March 31st. So I think that is a pretty good return. I'm pretty happy about it because I'm able to turn around a portfolio faster than S&P 500. So the next significant position I made is really around gold. So I invested in gold last year, which is actually Kirkland Gold, and then they got merged with another gold company called AEM. So there was a lot of events happening which caused the price to not go up immediately, even though the company itself is very fundamentally strong. Once the merger is over, then there's also the Russian-Ukraine war, which drove the gold price above $2,000, slightly above. And that's when I exited all of my gold position. And now, as of the time I'm recording this video for you, gold has dropped back to the 1900s. So now I'm looking at other opportunities in other industries. So when you're looking at this portfolio performance, it's only the first 3 months of the year, so I'm actually pretty optimistic for this year. It's important to keep in mind that there was a market crash somewhere between 2021 and 2022. And it's not immune to just me and you, like the retail investors. In fact, a lot of hedge funds actually experience that decline as well. So it just depends on what they're investing in, because industries are in different cycles. So when there is a decline in that specific sector, then that hedge fund would encounter the decline. So for example, in the first 3 months of the year, you will find that the big tech, like Apple, Google, Facebook, was temporarily in a correction mode, which is why the S&P 500 you see here is negative 4.62%. So one of the examples I got for you is Tiger Global. So Tiger Global is obviously one of the best hedge funds in the world. And if you look at what they do is they historically make double-digit return for many years. So I think I previously had the chart, but now I don't have the chart anymore. I don't know why Bloomberg changed the article. But if you look at here, the first quarter, they actually fell 34% in terms of return. So they actually lost 34%. So even hedge funds are not immune to this crash. So even though people didn't say it's a crash or whatever, you can see that even Tiger went down 34%. So that's why risk management is very important. There's no such thing as the perfect strategy. What you need to learn is really to manage your risk. The second one is Jim Simons. He's one of my idols. He's a really old guy, and he focuses mainly on short-term trading, like very frequently using algorithms or whatnot. So if I just zoom in here and I go to here, then you'll see his return for his various funds in 2020 is actually negative. So here you can see it was negative 19%, 30%, 30%. So it's actually not that uncommon for these hedge funds, even though they make a very high return and they aim for 20, 30% return or higher, to have a negative return year. So when you are planning your retirement, and I talk to a lot of people and they say, I can't take the volatility. Well, if you invest in the two of the best hedge funds in the world, Tiger and Jim Simons, you would have a down year eventually. So it is very important to ride it out, work on your portfolio if you are in that slump, and then you come back out on top. So in my opinion, I think the oil and gas and the gold play are over, which is why I no longer have a position. So going forward, you should probably look at post-pandemic. And I think that is what will continue to drive growth in your portfolio. And you do need to have that patience when it comes to investing. Another thing I learned is that over this period of market crash, market correction, it is very important to have cash on hand, because when it suddenly go on a discount, you want to put all your cash and average down as much as possible, because you know the economy will recover, the economy will reopen, people will travel again, and the pandemic will eventually be over. So one tip for you is really, I know a lot of funds that are currently buying right now. So then if you're feeling a little bit hopeless, if you're unsure what to do, just remember you need to think like a hedge fund. You need to think like a mutual fund. And if you think like them, then you wouldn't act emotionally. Right now, the stocks are down, which represents a discount instead of quitting. Now, of course, there's a caveat to this rule, is that you need to invest in good companies. If you invest in bad companies with bad fundamentals and bad earnings, then the chances of it recovering will be very slim. So that's why a lot of times when I'm teaching investing, I stress technical analysis, which is study the chart and the pattern, and I also stress the fact that you need to analyze the fundamentals as well. Because yes, technical analysis can tell you whether something is on a discount or not. It can tell you the price has gone down and where it is likely to have a support level, but it doesn't tell you whether it will recover or not. And when you're looking at stock investing, the future of the company, what will bring it back up is the fundamentals of the company and the way you understand the products, the business, and so on. So if you know those two, then you can form a successful strategy. And that's why in my strategy, I focus a lot on these two core pillars. And then once you have a successful strategy, then it is a matter of whether you want to multiply your profits using long-term options, or do you want to create a monthly passive income out of it? So I have been experimenting and implementing options to create monthly passive income and also long-term investing. And I think you need to use both strategies. So initially, when you are learning investing, you want to have long-term growth, tax-free compounding, then that's when you want to use a long-term strategy. As you're getting closer to retirement and you want to have a monthly passive income, then that's when you want to use options to create that cash flow for you, which pays for more predictable expenses. So let me use myself as an example. So here you can see my portfolio value is 450K, which is mainly long-term investing. So right now, this portfolio is still in the growth stage, so I'm not trying to take money out of it. I actually don't withdraw money out of my portfolio anyways. So I let it grow, which uses long-term options to multiply my return over time, selecting stocks that are at a discount and multiply them. So which is quite a straightforward thing to do. Now, let's say I'm planning to retire tomorrow. So if my target is to make 30% return a year with 450K, then you just take that number times it by 0.3. So let's say I round it to around 100K a year. So that means I would be aiming for 10K a month. So that's what I would do if I'm using the monthly passive income approach on this portfolio, which is to get 10K a month. And I think with 5 to 10K a month, a lot of people can already achieve their retirement goal. So the question is, how can you increase your return so then the amount of capital you need to be tied up can be reduced as much as possible? So that's why when it comes to investing, I rarely, or I actually don't, invest in index funds like S&P 500, because even though I'm getting like, 10% from S&P 500, it doesn't help me get to retirement fast enough because well, the growth is 10%, which I think it's okay, but it's not getting me 30% return, which is my target. And B, if I'm looking for a monthly passive income, well, S&P 500 return doesn't really generate it, and I can't really rely on S&P 500 to generate that return. So I need an alternative method to generate that monthly passive income. So right now, if I'm looking at my own portfolio with the retirement accounts, which I don't take any money out of, and the regular investing accounts here, which I don't take any money out of, then I'm going to have a third account, which I'm building right now, which is for monthly passive income as well. So that is kind of like at a steady state. And then I would draw money out of it on a regular basis to fund various expenses, whether that is a mortgage payment for my newborn son, for, groceries or whatnot. Those more predictable expenses needs to be matched with a more predictable strategy. My monthly passive income strategy is aiming for 30% return a year. So I know that it wouldn't get something like 22% in 3 months. It is worth it to implement monthly passive income strategy as well as long-term investing, because long-term investing itself is volatile. And I know as you approach retirement, or when you're thinking about retirement, you don't want that volatility. So that's why the monthly passive income strategy exists. But as a result of that predictability, you also give up some gains. So it's just really a trade-off. So for example, in the ideal world, if you have, let's say, 400K, and you want half of them generating monthly passive income, which is 3% a month, and half of them generating long-term return, like 30% a year, then you just allocated 200K each. So the long-term investing will be volatile, it will fluctuate because the market is unpredictable and there's always uncertainty. Whereas for monthly passive income, it will still be volatile, but it will be more predictable, which then you can budget to cover various expenses. So that's really how I think about retirement. That's how I think about, my return to date. I'm very happy that I'm able to turn around the portfolio faster than S&P 500 in the quarter. If you are interested in learning my investing strategy, then you can go to my website and watch the free case study, which is around 2.5 hours long. So that's that. And I'll see you in the next video.